Most beginners think leverage is what makes shorting risky. It's not. It's not knowing your liquidation price before you click the button. In this video, I'll break down how a short position actually works on crypto, what collateral is, how leverage changes your liquidation price, and how to set a stop loss the right way. We'll use Bitcoin as the example, but the logic works the same for any coin. This is not a signal, not a prediction. It's the mechanics every trader needs before opening a short. A short position is a bet that the price will fall. You open it high, and if the price drops, you close it lower. That gap is your profit. To open any leveraged trade, you need collateral. Think of it as the money you're putting down to cover potential losses. It's not a purchase, it's a deposit that backs your position. Here's the part most beginners get wrong. Leverage doesn't change how much you can lose. It changes how much room the market has before you get liquidated. Let's say you have $1,000 in collateral. At 3 times leverage, that opens a $3,000 position. At 10 times leverage, the same $1,000 opens a $10,000 position. But now the market only needs to move a fraction as much against you before you're liquidated. Same amount of money, same idea. Completely different liquidation distance. Let's make it concrete. You put down $50 as margin. You choose 3 times leverage. That opens a $150 position. Your $50 is what's at risk here, not the full $150. That's the entire point of margin. It defines your downside before the trade even opens. Now here's something that trips up beginners specifically on shorts. Your stop loss goes above your entry price, not below. Why? Because you're betting on the price falling. If it rises instead, that's your loss. So your stop loss protects you on the upside, not the downside. Even in a worst case move, your maximum loss on an isolated position is the margin you put down, not more. That's the entire reason isolated margin exists. It draws a hard line around your risk before the trade even opens. This is one possible way to structure risk. It's not a guarantee against loss. It's a way to know your loss in advance. Here's how this looks in practice on Margex. On the trade page, you pick BTCUSD, set your leverage with the slider, and choose your margin type R, isolated if you want your risk capped to that one position, cross if you're using your full balance across trades. You set your stop loss and take profit right in the open positions panel. Click the TP/SL field. Choose your trigger price, confirm. Then you click sell/short to open the trade. 3 mistakes to avoid: opening a short with no stop loss, confusing high leverage with high risk instead of a closer liquidation price, and using your full balance as margin instead of sizing the trade on purpose. Don't just guess your position size. Build a plan before you open the trade. So, collateral defines your risk, leverage moves your liquidation price, and your stop loss protects the side you're actually exposed to. That's the full mechanic behind a short. If you want to see how this plays out on a real setup, check the next video in the playlist, linked below. This is not financial advice. Always manage your risk.